Every financial system promises stability. History shows that stability is usually the warning sign. Most people think financial collapses happen because something suddenly goes wrong. A shock, a mistake, a crisis no one saw coming. But applied financial history tells a very different story. They begin with confidence. Markets feel calm, institutions sound certain, governments reassure, and that's exactly when the system becomes most dangerous. The myth of financial safety. In the United States, stability has become a national obsession. Stable growth, stable markets, stable prices, stable employment. But history shows that stability is often manufactured, not organic. And manufactured stability always comes with a cost. That cost is hidden risk. Now, why systems hate. Volatility exposes weakness. It reveals bad debt. It punishes leverage. It forces corrections. That's why financial systems work relentlessly to suppress it. Central banks smooth market swings. Governments backstop institutions. Regulators delay enforcement, not because they're incompetent, but because volatility threatens confidence. And confidence is the real currency of modern systems. The American cycle of delay. This pattern is deeply embedded in U.S. financial history. Before 1929, markets were calm and optimistic. Before the 1970s inflation crisis, growth looked unstoppable. Before 2008, risk was well diversified. In each case, warning signs existed. But the system chose delay over disruption. Why? Because disruption is politically expensive. Delay is quiet. When debt becomes untouchable, debt is the accelerant in every modern crisis. Low interest rates make borrowing painless. Refinancing replaces repayment. Rollovers replace responsibility. At first, this looks smart. Growth continues. Markets rise. Living standards appear stable, but debt doesn't disappear. It accumulates silently. Eventually, the system reaches a point where repayment becomes impossible without damage. The role of central banks are often misunderstood. They are not designed to eliminate risk. They are designed to postpone consequences. Rate cuts buy time. Asset purchases calm markets. Liquidity injections stabilize institutions. Each action makes sense in isolation. Together, they stretch the system far beyond its natural limits. History shows that once central banks become the primary stabilizers, markets stop pricing risk honestly. They price intervention. Why calm makes systems fragile? Here's the paradox. The longer a system stays calm, the more fragile it becomes. Why? Because calm encourages behavior that only works in calm conditions. Leverage increases, margins shrink, safety buffers disappear. The system looks strong, but it has no room to absorb shock. So when disruption finally arrives, it doesn't correct gently, it snaps. The silent transfer mechanism. When debt grows too large to confront directly, systems look for quiet exits. Inflation is one of them. Inflation doesn't announce itself as policy failure. It feels like inconvenience. Prices rise, savings erode, wages lag. No one votes against it. No one protests immediately. But inflation slowly reduces the real burden of debt. That's why history shows inflation returning again and again, not as an accident, but as a solution. Why people misread the danger? Most people look for danger in headlines, market crashes, bank failures, emergency announcements. But the real danger shows up earlier, when none of those things are happening, when experts sound confident, when volatility disappears, when the system feels managed. That's when risk concentrates, and that's when history tells us to pay attention. The language of reassurance. One of the clearest signals of delayed risk is language. Contained, temporary, transitory, resilient. These words don't describe reality, they manage expectations. Applied financial history shows that whenever reassurance dominates discourse, correction is being postponed. And postponed correction always returns with interest. Why this keeps happening? This pattern is not caused by bad people. It's caused by incentives. Short-term stability is rewarded. Long-term correction is punished. Leaders who delay consequences stay in power. Leaders who act early face backlash. So systems learn, they delay, they smooth, they reassure, until they can't. The real question. The question is not whether instability will return. It always does. The real question is, how much pressure is being stored beneath the surface right now? Because the longer stability is preserved artificially, the more violent the eventual adjustment becomes. When delay stops working, every system believes it has more time. That belief is not stupidity. It's structural. Financial systems don't experience pressure the way people do. They experience models, probabilities, and confidence indicators. As long as markets function, payments clear, and institutions survive, delay feels justified. But history shows a hard rule. Delay always works, until it suddenly doesn't, and when it stops working, the adjustment is never gentle. How trust actually breaks. Trust does not collapse overnight, it fractures. People don't abandon the system immediately, they hedge against it, they hold less cash, they accelerate spending, they move toward assets instead of savings, they seek protection quietly. This is not panic, it's rational adaptation. History shows this phase clearly in every major breakdown. By the time trust is visibly gone, behavior has already changed underneath. Why markets? Snap after long calm periods. This is one of the most misunderstood dynamics in finance. Long calm periods don't reduce risk, they concentrate it. During extended stability, leverage increases, safety margins shrink, risk becomes normalized, warnings are ignored. Eventually, the system becomes dependent on calm itself. So when volatility finally returns, even slightly, the reaction is extreme, not because the shock is large, but because the system has no tolerance left. History confirms this again and again. The moment policy loses control, once trust begins to fracture, policy becomes reactive, interest rates are raised aggressively, liquidity programs expand rapidly, emergency measures appear overnight. But by this stage, policy is no longer shaping outcomes. It is chasing them. Liquidity can stabilize prices temporarily. It cannot restore belief. And without belief, financial systems do not heal, they deteriorate. Why blame always shifts. When consequences become visible, narratives change. Suddenly, inflation is blamed on supply chains, corporations, consumers, foreign actors, speculators. This is not confusion, it's insulation. By spreading blame, the system avoids confronting its own structure. The real cost of manufactured stability. The true cost of artificial stability is not economic, it's psychological. People stop trusting prices, they stop trusting savings, they stop trusting long-term planning. Short-term thinking replaces patience, speculation replaces discipline, survival replaces strategy. This is how societies become fragile, not through collapse, but through erosion. Who pays when stability breaks? History answers this question with uncomfortable consistency. Those closest to money creation adapt first. Governments refinance, institutions reprice. Large asset holders adjust. Households adapt last. Wages lag. Savings lose value. Purchasing power erodes quietly. This isn't a conspiracy, it's sequencing. And sequencing determines outcomes. Why savers always lose. Savings represent stored time. Inflation erodes stored time. That is why inflationary systems always punish savers, not because savers are irresponsible, but because stored value threatens systems built on delay. History shows that persistent inflation eventually discourages saving altogether. Consumption rises. Speculation increases. Stability becomes harder to maintain. The cycle feeds itself. The final stage, acceptance. There is a moment history identifies clearly. It's when people stop asking, when will things go back to normal? And start asking, how do I survive this? That shift marks the end of belief and the beginning of adaptation. Once this happens, no policy announcement can restore trust quickly. The system may continue functioning, but legitimacy is gone. Why this is not a doom story. This is not about predicting collapse. It's about understanding behavior. Systems fail not because people are stupid, but because incentives reward delay. Leaders choose stability today over consequences tomorrow. That choice feels rational until tomorrow arrives. History doesn't judge these decisions morally, it simply records the results. What applied financial history actually teaches, it doesn't teach dates, it doesn't teach forecasts, it teaches patterns. And patterns repeat because incentives don't change. Understanding these patterns doesn't make you fearful, it makes you aware. Awareness is the only advantage individuals ever have in large systems. The most important insight, the most dangerous phase of any financial system is not crisis. It is confidence. Because confidence delays correction. And delayed correction is always more painful. Final reflection. Every financial system eventually faces the same choice. Confront reality early, or postpone it quietly. When postponement wins, collapse is not sudden. It is the final step of a long process. And by the time it becomes visible, the decision has already been made. If you want to understand money, power, and financial systems before the consequences appear, not after the headlines, subscribe to Wheelixon. This channel doesn't chase panic, it studies patterns. Because once you see the pattern, you stop being surprised by the outcome.